speaker, CA Achal Jain, and all the members who are participating in this video conference meeting. I am delightful to be part of this 5-day series of VCMs on accounting standards for non-corporate entities. Today, we are going to deal with AS1 disclosure of accounting policies, AS2 valuation of inventories, and AS7 construction contracts. I am happy to introduce today's speaker, Achal Jain. In brief, Achal is a chartered accountant from the Institute of Chartered Accountants of India and BCom honors from University of Delhi. He is currently into practice with a specialization in assurance and advisory services. Prior to this, he worked with the assurance and advisory practice of Deloitte Haskins and Sells, SR Bartleby & Co. LLP, and Walker Chandiak and Company. He has more than 15 years of post-qualification experience in accounting, audits, and financial reporting. In his role, Achal has managed statutory audit engagements for several clients with presence in India and overseas. He has also assisted Indian and global companies in transitioning to India's IFRS, implementing complex accounting guidance related to IFRS, US GAAP, and Indian GAAP. Knowledge of reporting requirements under India's IFRS, US GAAP, and Indian GAAP. Significant experience in assisting clients across industry sectors like manufacturing, real estate, power, construction, service, software, media, and trading. He is having considerable experience in conversion projects from Indian GAAP to India's IFRS and US GAAP. He is having the professional experience of more than 15 years of post-qualification experience in assurance and advisory services. During these years, he gained extensive experience in serving large and medium-sized corporates across various industries under India's IFRS. Some of his experience includes companies like Tata Steel, BSL, Tata Chemicals, Escorts Limited, Jindal Stainless, Ashok Leyland, Hero Group, Bata Limited, MRF, Bharti, Airtel, and etc. Worked on various publications for Big Four firms which covered various aspects related to India's and IFRS. Some of them are also available on public domain also. He has also assisted clients with various IPO projects. He is an active speaker with ICAI for India's training programs and other programs. He has been a member of the study group of the Accounting Standards Board of ICAI. He is a technical reviewer with Financial Reporting Review Board of ICAI. With this brief, I introduce CA Achal, today's speaker, to our members. And I request Achal to go ahead.
Thank you so much, sir, and thanks for giving me this opportunity to be a part of this session today. And thanks everyone for joining this session. And it will be great to have this discussion with you regarding some of the very important aspects of accounting, which is definitely through the accounting standards, and we understand the importance of all of these accounting standards. The agenda for today definitely captures some of the standards which are, I would say, towards the startup stage or which are very, very basic to the financial statements, whether we talk about AS1 or AS7. But having said that, AS1, AS2 or AS7, we can also say are the most relevant standards, be it any size of the entity. Means to any size, to any entity, these standards become very, very applicable. So that's why these are very, very relevant, and it's important to understand some of the aspects related to these standards. Also considering the fact that there are so many regulatory changes which are taking place, and there are so much reviews, there are so much regulatory requirements which are important for the professionals to take care of, whether we are looking at it from the audit side or whether we are looking at it from the management side. So I'll start the discussion with Accounting Standard 1, which deals with the accounting policies and the disclosures around it. Now, as regards this standard, we can say, deals with some of the very basic concepts in relation to the preparation and the presentation of the financial statements. And before moving on to accounting standard 1, we should also understand that there is a framework. There's a framework in respect of preparation and presentation of the financial statements. That framework helps the entities to understand what is the meaning of asset, what is the meaning of liability, what is really meant by current or non-current, and some of these very basic aspects which are required in respect of preparation and presentation of financial statements. So we are just carrying forward that understanding of the framework, and we'll try to use that understanding of the framework and apply that while we consider this discussion in relation to accounting standard number 1. So moving further on to this accounting standard 1. As we discussed, the objective of the standard is to focus as to how do we really deal with the drafting of the accounting policies, or this is really focused on the accounting policies which form part of the financial statements. And accounting policies, we can say, is the base. Accounting policy is the base, because this accounting policy is something which decides as to how an item will be recognized and measured in the financial statements. So if there is anything which goes wrong in the accounting policy, then it will automatically go wrong in the presentation, in the recognition, in the disclosures. Yeah. So let's try to understand the meaning of accounting policy. What do we mean by accounting policy? We can say accounting policy is nothing but an accounting principle, or we can say a specific accounting principle, or the methods of applying those principles. Now, where are those principles going to be used? Those principles will be used by the management while preparing and presenting the financial statements. Let us take an example for this. Revenue recognition. We all understand about revenue recognition. And revenue is something which is a very important component of financial statements, or very important for any entity. Now, how is this revenue going to be recognized? Means, what is the amount of revenue that will be recognized and measured by the entity in the financial statements is something which will be driven by the accounting policy of the accounting policy of the company will give this layout as to how this revenue will be recorded. Similarly, let's take an example of inventory. We all understand about inventory valuation, and we all understand that for inventory valuation there are two methods which a company will follow. First in first out method, which is called as FIFO method, or it could be about the weighted average method. Now, how the inventory is being measured by the company, and using which the numbers of inventories are recorded in the financial statements, are required to be specified first of all in the form of an accounting policy. Or in other words, we can say it's the accounting policy which lays down the basis for measurement of the inventory. Means, if the inventory policy of the company says, of the entity says, that the inventory will be recorded on FIFO basis, in such a case, entity will be recording the inventory, entity will be valuing its inventory using FIFO method and not the weighted average. Now, how is this established? For the purposes of this accounting policy, or for the purposes of specifying these accounting principles, now what will become the basis? First will be the accounting standards. It means that for setting these accounting principles, we need to go to the respective accounting standard. For example, for inventory, we will go to AS2. That means the accounting standard or inventory. For revenue, we will go to AS9. That means the accounting standard on revenue recognition. Similarly, for each and every item, we will first of all refer as to which accounting standard exists, and the guidance which that accounting standard provides will be used for setting up the accounting principle, or you can say for framing the accounting policy. But sometimes it may happen that a particular guidance or maybe a specific guidance is not available in an accounting standard. Why? Because maybe for recognition of some items, for measurement of some items, currently the guidance is not available under accounting standard. In such a case, what do we do? In such a case, we need to check if there is any other guidance available in the form of a guidance note, in the form of any advisory which is being issued, or in the form of any other guidances which are available. If none of those are available, then the accounting practices which have been adopted over the years and which are well established accounting practices, those become the basis for the recognition, measurement, presentation, and disclosure. Now, this is something which we can say lays down the foundation for setting the accounting principles. And let's try to understand as to why this accounting policy is important. Now, when we talk about any item in the financial statements, one thing is understood, that such an item is getting recognized, getting recorded in the financial statements because there is an accounting policy for the same. But in case an item has been recorded in the financial statements for which accounting policy is available, but for some reason if that accounting policy has not been disclosed in the financial statements, then what will happen? The users of the financial statements, they will not be able to understand that how this particular item has got recorded in the financial statements. Let's come back to our example of inventory. Say the entity has recorded inventory using FIFO method. Now, if you go to the balance sheet, if you go to the notes to accounts, nowhere in the balance sheet, nowhere in the notes, FIFO method is specified. Why? Because it will only talk about the inventory and the amount at which inventory has been recorded. The basis for recording of all of these amounts is mentioned only in an accounting policy. And if for some reason that accounting policy is missing, will the user be able to understand that ever? No. User will not be able to understand that. User will not be able to appreciate that. So that's why it's very, very important that the accounting policies, or we can say the significant accounting policies, are disclosed in the financial statements. Because if the significant policies are disclosed in the financial statements, the user will be able to easily understand as to how all of these items have been captured, have been recorded in the financial statements. Otherwise, it will go missing, or otherwise, user will not be able to connect or to establish as to what has been the basis of recording of all of these items in the financial statements. All right. Now, disclosure of accounting policies is important to understand, as we discussed, is important to understand various components of the financial statements. That is first. Now, at times, it may also happen that an accounting policy of a company, of the entity, has been changed. It's possible that an entity has changed its accounting policy. Now, whenever there's a change in accounting policy, for example, During the current year, entity has changed its accounting policy from FIFO to weighted average. Now here again, if let's suppose in the previous year, the method of recording inventory, valuing inventory was FIFO. Let's suppose in the current year it's been changed to weighted average. All right. And the accounting policy now reads that the inventory has been valued using weighted average method, which is the method used for the current year. Yeah. But this change has arisen in the current year as compared to the previous year. If this is not mentioned anywhere, if this is not specified anywhere, then what will happen? Again, this will be considered as if some information is missing from the financial statements. In such a case, it will be considered as if there are certain facts which have not been properly captured. Why? Because the users of the financial statements, they will not be able to understand that during the year a change in accounting policy had taken place. They will not be able to appreciate the change in the accounting policy or the impact due to change in this accounting policy which was there in the financial statements. So that's why, as regards the accounting policy, it's very, very important to disclose it. And whenever there's a change, we should also disclose if there is any change in the accounting policy. Disclosures of the accounting policies, or if there is any change in the accounting policy. Yeah, both of these are required to be appropriately disclosed in the financial statements for users to appreciate that. Now, let's try to understand some of the very basic aspects which are required to be considered whenever an accounting policy is chosen. For this, we need to go back to the fundamental principle. What is the fundamental principle while preparing the financial statements? The fundamental while preparing the financial statements is that whatever financial statements have been prepared, they should reflect true and fair view. True and fair view has to come out. Sorry, I think there was some disturbance. The fundamental principle is that the financial statement should give the true and fair view. That's why every such thing should be taken care of in such a manner that the accounting policy will result in having the financial statements which reflect true and fair view. And for this, let's try to understand some of the important considerations. First, of course, is about the prudence. Prudence is very, very important. We follow the principle of prudence. Now let's try to understand what do we mean by prudence. The basic approach that we consider while recording an item in the financial statements is the conservatism, which says that the losses, expenses, they need to be accrued. They need to be accrued. And this is now very, very important because I have seen in most of the cases that this is one area wherein errors are generally formed. And that is the difference between accrual basis and cash basis. Generally, for non-corporate entities, this difference of cash basis and accrual basis is missed out. which is not appropriate. We need to always appreciate the fact that the accounting has to be on accrual basis, which would mean that any expenses which have been incurred, they need to be accrued properly. If the expenses which have been incurred, they have not been accrued, that means we are missing out on recording of an item in the financial statements, which is not appropriate and which is very important to be considered. And let's now come back to the principle of prudence. Principle of prudence means that while recording an item in the financial statements, we have to be conservative, expenses have to be accrued, losses have to be booked, but we need to be bit aggressive in terms of recording the gains. Gains have to be recorded only when they have been realized, except in some cases. For example, revenue, which we record on accrual basis. So I'm not saying that revenue will be recorded on cash basis. We are talking about some other gains. For example, if we talk about the derivative gains, etc. This is first aspect which will be considered for recording any item in the financial statements. And therefore, this is very important aspect for drafting an accounting policy, or you can say for selecting an accounting policy. Next aspect is about consideration of substance over form. Now, what do we mean by substance over form? Our accounting standard requires us to follow the principles and not really be driven by the rules. Though at times it's important to follow the rules. So I'm not saying that we can just ignore the rules. Accounting standard says that there are certain aspects, there are certain points which at times may not align with the legal drafting. Let's try to understand this. Say, for example, there is a contract. If you read that contract, this contract is nothing but a lease contract. If you read the contract, you'll understand that it's a lease contract. But if you look at the contract doesn't specify that it's a lease contract. Contract says that it's a service contract. Means the header, everywhere in the contract it's been specified as service contract. Means legally, if you look at the contract, you will find out that it's a service contract. But in substance, if you'll understand the intent of two parties which are there in the contract, the way those two parties have agreed on various terms and conditions, if you'll understand the substance behind entering into that contract, you will find out that this contract is not a service contract but a lease contract. In such a case, standard says that we should follow substance and we should not really go by the legal form. And accounting in such a case should be done on the basis of the substance of the contract. So we are not saying that we can just ignore that contract. No, we will follow the contract. And various rules and regulations which are attached to that contract will also be complied with. I'm not saying that we'll just start violating the rules and regulations which are around it. No, we are only saying that when it comes to the accounting, we have to go by the substance and not really by the legal form. This is another aspect which has to be considered while doing the accounting. And therefore, whenever we have to select the accounting policy, we need to take care of this fact that we have to consider the substance and not really go by the legal form. Number third is about the materiality. Something which is very, very important and very, very relevant. And I would say almost everyone will appreciate this fact. And particularly for non-corporate entities, this aspect becomes extremely important. And this is based on my practical experiences, wherein aspect of materiality is generally ignored whenever we talk about non-corporate entities. Why? Because generally non-corporate entities are of a small size, or you can say medium size. Generally this is what we find, and therefore we ignore this aspect of materiality. Let's try to understand the meaning of materiality first of all. What do you mean by materiality? Materiality means something which can impact the decision making of the users of the financial statements. Or we can say, if there is an item which has such an impact that such an impact can affect the decision of the users of the financial statements. Say an item has been recorded at rupees 1 crore instead of 2 crore. So there's a difference of 1 crore. If we say that this difference of 1 crore is such that the decision of users of financial statements will get impacted, then in such a case, that 1 crore is considered to be material. And if you look at it from the auditing aspect also, auditor has to take care that the financial statements are free from material misstatement. Material misstatement means there should not be any material error in the financial statements. If the error in the financial statements is material, that needs to be adjusted. Here again, auditor is also looking at only at the material errors, not at all the errors, because it's not practically possible for the auditor to find out each and every error. Yeah, not the same aspect is required to be considered by the management. That within the financial statements, there could be certain items which are not material and which may have got ignored because they are below material. Now, whenever we are looking at the financial statements, whether it is about preparation or whether it is about review of the financial statements, we have to make sure that this aspect of materiality is properly understood by us. Now, as we discussed, that materiality is nothing but a threshold. And this threshold has to be decided depending on the nature of the business, depending on the size of the business, depending on the type of the transactions, depending on the complexity, and depending on various other factors related to the entity. And if there are any errors, if there are any such adjustments, if there are any such accounting entries which are below materiality, then we are okay if those items are missed out. We are not saying that we should miss out on any of such items. We are saying if those items on a cumulative basis are missed out, and if on a cumulative basis they are below materiality, then this will not impact the financial statements in a significant manner. That's why we can just ignore this aspect. Now, why I was saying this is very, very relevant in the context of non-corporate entities is because the moment we come across any non-corporate entity, and because of the fact that the non-corporate entity is generally not of a large sized, that's why we forget this principle of materiality. And we try to capture each and every adjustment which is possible, whether we are looking at it from the management side or from the audit side, which is not appropriate. And therefore, we should make use of this sort of cushion which is available. If we happen to be the auditors, and if we are not really the auditors, we as the management should also be wary of the fact that there is a materiality. If there are any items which are materiality, and if those are missed out, it's okay while preparing the financial statements, while presenting the financial statements. And therefore, whenever we look at the accounting policy, whenever we draft an accounting policy, we have to remember this fact that irrespective of the accounting policy, irrespective of the accounting which is suggested by the accounting policy, there are going to be such adjustments which will remain below materiality and which are okay if those are missed out. All right, yeah. So these are some of the considerations which one has to keep in mind while selecting an accounting policy, or in simple terms, we can say while preparing or presenting the financial statements. Now moving further on to some fundamental accounting assumptions. As we discussed, there's a framework with respect to the presentation of the financial statements. That framework also talks about some of the fundamentals using which financial statements are prepared. And these fundamental accounting principles or assumptions, we can say, are those assumptions which is understood by the user as if that item is already captured. For example, if nothing is specified in the financial statements as regards the basis of accounting which is followed, and by basis of accounting I mean to say accrual or cash basis of accounting, if nothing is specified, and let's suppose if you happen to be the users of the financial statements, what will you assume? You will assume that it should be accrual basis. Yeah. And why will that assumption come into play? Because this happens to be a fundamental accounting assumption. Fundamental accounting assumptions are those assumptions using which financial statements are required to be prepared always. Means they cannot be prepared using any other assumption. It's not allowed. Only these assumptions are allowed. And that's why whenever it comes to the preparation, whenever it comes to the presentation of the financial statements, these are not required to be disclosed anywhere in the financial statements. Nowhere in the financial statements we will say that accrual basis of accounting as a fundamental accounting assumption has been used. It's not required to be disclosed. However, if for some reason any item in the financial statements has been recorded without following accrual basis, in such a case its disclosure becomes important. Why? Because then we are deviating from the fundamental accounting assumption. So disclosure is only required to be given whenever there is a deviation from whenever there is a deviation from fundamental accounting assumption. Otherwise, the disclosure is not required to be. So we are not really talking about the accounting policy right now. For an accounting policy, disclosure is mandatory. For an accounting assumption, disclosure is not given. But whenever there is a deviation from accounting assumption, disclosure is required. Because that is first of all not acceptable. So that's why some exception, if at all, has taken place, that is required to be disclosed. Next assumption, which happens to be fundamental, is about the going concern. Now again, going concern is a very important assumption. Let's try to understand why. See, whenever it comes to the preparation of the financial statements, whenever it comes to the preparation of the financial statements. Now, it is something which will become the basis. It is something which will become the basis. Means whenever the financial statements are prepared, it is assumed as if the entity will continue as a going concern. And going concern means that the entity will be able to operate, will be able to continue its business at least for 12 months from the balance sheet. Okay, so that means if we do not see this disclosure regarding the going concern, means if there is nothing specified around the going concern, what do we assume? That yes, entity is good to go and entity is able to continue as going concern. If at all there is any doubt around it, disclosure is required to be given. Next fundamental accounting assumption is about the consistency of the accounting policy. Now this is again very important aspect. Let us try to understand, and I think everyone will be able to relate to this. When it comes to the accounting policy, in any accounting policy, you would find that there's a consistency. Year one, a particular accounting policy has been followed. Same accounting policy will continue in year 2, 3, 4, 5, and so on. Standard requires that the accounting policy should be consistent year on year. It should not happen that in the first year, inventory was valued on FIFO basis. Second year, it's changed to weighted average. Third year, it's changed to FIFO. Fourth year, it's changed to weighted average. Fifth year, it's continuing as weighted average. Then again, it is changed. If this consistency doesn't remain, then what will happen? The numbers which will get recorded, will they be comparable? Will the user be able to appreciate two sets of financial statements? No. Why? Because every year there's a change. So that's why it's very, very important to have consistency in the accounting policy. And as regards these three assumptions, going concern, consistency, and accrual, standard requires there is no need to disclose. That's why you will not find a disclosure for these assumptions. However, if any of these assumptions is not followed in the financial statements, then such a disclosure is mandatory. Ideally, you will not see that happening. But if for some reason, if that happens, then the fact should be disclosed. Then in such a case, disclosure becomes important. Okay, yeah. So now we'll look at a few examples. Contribution to pension fund. This is something which is related to employee, I would say. Contribution to pension fund is made based on actuarial valuation as at the year end in respect of employees who have opted for pension scheme. Okay. Contribution to the gratuity fund. Now it's a different fund. Contribution to this other fund, that is gratuity fund, is made based on the actuarial valuation as at the year end. Yeah. Third, leave encashment is accounted for on pay as you go method basis. Now for contribution to pension fund, contribution to gratuity fund, the basis which has been followed for valuation is actuarial valuation. But for leave encashment, it's not the basis. Some other basis has been followed other than actuarial valuation. We are required to comment on this, check this. Now, if we follow AS1, what does it say? accrual basis has to be followed. Accrual basis is the fundamental accounting assumption. Accrual basis is the fundamental accounting assumption. Therefore, any accounting policy cannot be contrary to fundamental accounting assumption. Policy followed for leave encashment on the basis of pay as you go is not in accordance with accrual assumption. Why? Because this is something which is nothing but the cash basis. What do you mean by pay as you go? Means whenever you are going, whatever is you do, you will pay you. Cash basis of accounting, which is something other than the accrual basis of accounting. Therefore, when it comes to such an accounting policy of leave encashment, we cannot say it is correct. We cannot say that it is in line with the accounting standards. Moreover, if you look at accounting standard 15, which I'm sure you would have gone through, if you look at accounting standard 15, that is about employee benefits, this accounting policy is also not in line with accounting standard 15. And let's go back to our discussion, something that we discussed, that accounting policy has to be an accrual basis. Accounting policy, whenever it has to be selected, it has to be selected on the basis of the relevant guidance in the accounting standard. Now, for this type of transaction, which is related to employees, which one is the relevant accounting standard? AS 15. So that's why whenever an accounting policy for leave encashment will be framed, the basis for the same should be accounting standard number 15, which doesn't seem to have been followed in this case. That's why if we talk about contribution to pension fund, contribution to gratuity fund, their basis of measurement recognition seem to be appropriate. But leave encashment is not something which is appropriate. All right. Okay. Now, as regards the disclosures, so the standard talks about the disclosures only, but still if you check about the disclosure requirements of the standards, something that we have discussed, that all the significant policies should be disclosed in the financial statements. All the significant policies which have been adopted for accounting purposes, they are required to be disclosed, and those should be disclosed at one place. It should not happen that policy for inventory is disclosed at the beginning of the financial statements, policy for employee benefits is disclosed say on the third page, then policy for say for example revenue recognition is disclosed on page number 7. No, it's not appropriate. All the accounting policies have to be at one place. They have to be at one place. Further, whenever there is any change in an accounting policy, that change is required to be disclosed. And any impact which arises in the financial statements due to such change in accounting policy should also be disclosed. Any impact in the financial statements due to such change should also be disclosed in the financial statements. If for some reason the impact is something which cannot be quantified, that is not ascertainable, then such a fact should also be disclosed. That there was a change because of which there is an impact, but that is not ascertainable, that cannot be quantified, that fact is also required to be disclosed in the financial statements. So let's look at this example now. An entity, say X, is engaged in manufacturing of bricks. Apart from this, it is also engaged in sale and purchase of land. Okay. Generally, it purchases land from individual landowners and sells that to real estate developers. As the entity deals in land, so it recognizes land as inventory as a separate item in the closing stock schedule along with inventory of bricks in its financial statements. But this entity discloses its accounting policy only in respect of valuation of inventory of bricks. It doesn't give the disclosure around valuation of land as an inventory. So can we say that this entity is not following the requirements of AS1? Over to you. Just think about it, and let me just also share some thoughts around it. Yeah, so just start thinking about it. Now, when we talk about the disclosure, this entity is disclosing the inventory of land as a separate item in the closing stock. So that means separately an inventory is getting recognized, measured, presented in the financial statements. Okay. And therefore, it will be appropriate to assume that if the land is getting separately presented, then it must be a material item. Yeah, it should not really be of very, very small value, which is below material. And if there is an item which is getting captured in the financial statements and that is material, that's why basis of recording that item has to be there in the accounting policy, and that accounting policy has to be there in the financial statements, which seems to be missing in this case. That's why, what do we say? Accounting policy of the entity is not appropriate. Appropriate in the sense, it is only partly complete. It's not fully complete. Or in simple terms, we can say that the accounting policy is not in line with the requirements of accounting standard number 1, which the company has to correct. Otherwise, it will be considered as if there is a violation of AS1. All right. Let's look at another example. No? An entity, while preparing its financial statements and while framing its accounting policies, has used the language inventories are valued using weighted average cost method or specific identification method as applicable. Can we say that this accounting policy is appropriate? The answer again is no. Entity should have specifically stated the policy for valuation of inventory. In the given case, if we happen to be the users of the financial statements of this entity, what will happen? We will not be clear. We will not be clear as to what is the basis of measurement of this inventory, because nothing is specified. If the company is dealing into 5 types of inventories, first 3 types are measured using weighted average or specific identification is not clear. Yeah, it's not clear. User has been left to guess that out of these 2 methods, any of the method will apply to all the items of inventory. So actually, this inventory policy is not specific, but the policy has to be very, very specific. Specific to the items which are getting recorded in the financial statements. Otherwise, that policy will not be considered to be approved. Okay. Another example. An entity has stated in its financial statements that revenue has been recognized in accordance with AS9. It doesn't talk about the basis. It doesn't describe as to what becomes the basis. It simply says whatever AS9 requires, we have followed. Now, what is required by AS9 is not specified. Can we again say that this inventory, sorry, this policy of revenue recognition is appropriate? Again, no, because it's a very vague accounting policy. It's not specific. It talks about entire accounting standard. Now, this accounting standard covers various aspects. Yeah, it talks about various guidances. Now, which guidance is relevant to the company, to this entity, which guidance is applicable to the entity is not clear. That's why here again, what should the entity do? Entity should be very, very specific. Entity should specify that what is that revenue type which is being discussed. Are we talking about sale of goods? Are we talking about sale of services? Are we talking about any other income which has been dealt by AS9? And we need to talk about each and every such type of revenue using the guidance which is there as per AS9. Just simply giving a reference that everything as per AS9 has been followed will not be considered to be appropriate. So that's why here again, the accounting policy which the company has considered is not appropriate. Yeah. All right. Next example. An entity is engaged in trading of fast moving consumable goods. It has invested more than 50% of its net worth in shares of other companies. Dividend income on those investments constitutes a significant portion of the total income of the entity. Just remove this word company. I am just changing this with entity. The entity has not disclosed its accounting policy regarding these investments and the dividends which have been earned. Can we say that this accounting policy which has not been disclosed is appropriate? Here again, it's inappropriate, because if there is something which is getting recorded in the financial statements and that is material enough, then the entity should have an accounting policy for the same. Another example. An entity is in the business of providing telecommunication services. It has adopted policy on disclosing of prior period items. As per the policy, income of prior periods will be disclosed as prior period income only if it exceeds a threshold of, say, X amount. Say, for example, a threshold of 10,000. If it crosses a threshold of 10,000, only then it will be recorded as prior period item, otherwise not. So that's the policy which the company has followed. Now, in the given scenario, what we need to comment is, what we need to assess is that whether giving a threshold and recording an item only if it crosses a particular threshold, or you can say ignoring all the items which are below this particular threshold, be appropriate? The answer is yes. The answer is yes. And why is this so? Because there is a fundamental accounting assumption of materiality. If this threshold of 10,000 or below, which is being followed by the entity, is something which is below the materiality level, then anything which this entity is missing out on, which it is not capturing in its financial statements, will be considered to be appropriate. Will be considered to be appropriate. And why so? Because all of those items which are not getting recorded as prior period item, and instead they are getting recorded as, say, some other thing, means their presentation has changed as compared to what it should have been in the financial statements. So this change in the presentation, the impact on the financial statements is not significant, is not material. That's why having such thresholds can be considered by the management. The only thing is this materiality factor has to be properly assessed by the management. Clear? All right. So with this, let us quickly summarize this entire discussion related to AS1. So AS1, as we have discussed, talks about the accounting policies. We understood as to what do we mean by accounting policy, and regarding the accounting policies, we need to remember that there has to be a proper disclosure for the same, and whenever there is any change in the accounting policy, that fact should also be required to be disclosed. There are certain fundamental accounting assumptions which are not required to be disclosed, but if there is any deviation in those fundamental accounting assumptions, those deviations are required to be disclosed. Clear on this? So with this, we come to an end to this standard, and before we move on to the next standard, let's just come to your queries, any questions, any doubts that you may have. And I would request
Yes, sir. Yeah,
if the
I
queries
will
can be
share
read
my,
out, please.
yeah, I will share my screen. So there are two questions. We'll take up those and then we'll move on to the next session.
Sure.
I'm just sharing my screen. Is my Excel sheet visible?
Yeah, this is visible. All right, so let me just read out this query number 1. For a known company entity, should we disclose all the policies irrespective of the fact they are relevant or not? For example, PF, ESI are not applicable to the entity, forex transactions are not going to happen, etc. Please clarify whether we can just leave it from the accounting policies. The answer is yes, and it's not about whether we can leave or not. We have to leave. Let me just go back to the discussion around the accounting policies. We have to remember the fact that accounting policy has to be specific to the transactions which have been recorded in the financial statements, specific to the assets or liabilities which are recorded in the financial statements. If the entity doesn't have any forex transaction, okay, and if we give the disclosure regarding policy on forex transactions, then what will happen? User of financial statement will get confused. But you can say he will think as if this entity has got forex transactions for which the basis has also been given. But is that appropriate? The answer is no, that is not appropriate, because that is not the correct basis. So that's why we have to be very, very specific, and that's why only those transactions which exist, only those assets or liabilities which exist will have an accounting policy. Otherwise, anything else should be missed out, and this is generally which is not being followed in the financial statements. Generally, what do? We will, whenever we'll draft the accounting policy, what do? We'll pick up the financial statements or say accounting policy of a large company, and we'll just copy paste the accounting policy. We'll change the language, but some of the accounting policies which are not really relevant to the entity, will keep it, which is wrong, which is not something which should be done. Okay, moving on to the next query. In a case where consistency is missing in the current year, the impact of such inconsistency on the bottom line not ascertainable for the various reasons. Do we need to qualify the report? I think it will be great if you can just be specific in terms of your query. But if you're saying that if the consistency has not been there, say for example, during the year an accounting policy has been changed. Okay. Now, if the management has a good reason of changing the accounting policy, which is permissible, if the accounting standard requires this, maybe new provision is there, new guidance is there, or the accounting standard has changed, because of which accounting policy has been changed, that is acceptable. If there's a legal requirement which requires change in accounting policy, that is acceptable. Third is if the management considers it appropriate. Why? Because by changing the accounting policy, financial statements will be more useful. will give more appropriate picture. Now, this is something which is judgmental and which has to be evaluated appropriately. But using this, every year accounting policy cannot be changed. However, if for some reason in a particular year accounting policy has been changed and there's a good reason for changing this, then that good reason is something which is acceptable, which is required to be considered by the entity. And we don't really think there's a need to qualify in such a case. All right.
So these two are questions, sir, and if there is any, we'll take it up. As of now, there are no questions. So we'll go to next standard, or else we'll be having a break, sir.
I think we can just break for 5 minutes before we move on to the next standard.
Yes, sir. I'll just put a slide. You let me know when you're ready. I'll share you the presentation.
Sure. All right.
Or take it to those.
We can continue with our discussion.
Sorry, sir. Yeah, I'll give you the rights.
Yeah.
I'll give you the rights.
Right. So is the screen visible now?
No, not yet, sir. I given you the rights. Just click on show my screen button.
Okay.
Yeah, now it's visible.
All right. All right. So now we'll move on to the next topic, and which is about inventories. And once again, I will say very relevant topic in the context of any type of entity that we look at, because in most of the cases, in most of the businesses, we'll find this item to be applicable. And we are talking about inventories. So let us understand as to what do we mean by inventory. I think with the help of this definition, we should be getting clarity as to what is this inventory, and then we'll have a detailed further discussion on this aspect of inventory. Inventory is an asset, and that asset which is held for sale in the ordinary course of business. Means if an entity is keeping an asset, is purchasing an asset, and the objective is to then sell that asset, then such an asset will become inventory. For example, if the entity has the business of, say, trading into furniture, so now the entity will purchase furniture and sell furniture. Why is this furniture purchased? With the objective of sale. Furniture is not purchased for the purposes of use in the office. No. Objective is to make money by selling the furniture. That's why in such a scenario, that furniture will become inventory for the entity. That furniture will become inventory for an entity. Next, assets that are in the process of production for such sale. Let us take an example for these types of assets. What are these types of assets which are in the process of production for such sale? Say an item has, say an entity has purchased some raw material. Say an entity has purchased some raw material. Now that raw material is currently in the process of production. Finished good has not been generated. That is still in WIP form, work in progress form. The moment it will get converted into finished good, it will be sold off or it will be available for sale. Currently, it's in the middle of the production stage, because depending on the type of item, their production cycle may vary. Okay, the time frame for their production may vary. Some of the items may take only few minutes to be manufactured, and some of the items may take hours, or some of the items may take days to get manufactured. Once they will get manufactured, once they will get produced, idea is again to sell it off. Those items will also be considered as inventories. Third, assets that are in the form of materials or supplies to be consumed in the production process or rendering of services. Here again, we are talking about various materials, various supplies which will form part of this production process. Yeah, all of those supplies will be used for those production process, will be forming part of that finished good which is going to be produced and which is then going to be sold off, because that's the objective, that's the business model. So all these types of assets are nothing but the inventories for the entity. And I think all of us are very familiar as to what is an inventory. Okay, there's nothing which is so special about it. Now, we have understood as to what is the meaning of inventory. Now comes the point as around the measurement of this inventory. Inventory is initially recognized at cost. Initially recognized at cost means at the first point, it is measured at cost. Cost means its acquisition price or the amount which has been spent for procuring this. Inventories are always recognized at cost initially. Means initially no other basis will be used. They will always be measured at cost. Always. Their initial recognition will be at cost for sure. Now question arises that inventory will be measured at cost initially. Therefore, it's important to understand the components of those costs. It's important to understand the components of those costs. So let's try to understand the components of those costs. Now, before I really get on to all of those components of costs, which comprise of inventory, some of the things which are important for us to understand. I'll just follow the basic principle over here. That whenever we have to estimate the amount of cost of the inventory, whenever we have to check the amount of cost of the inventory, we need to include all such costs which are incurred for bringing the inventory to this present location and condition. For example, an entity which is dealing into trading of furniture. Now, what would be the cost components for this entity? Let's try to understand that. First cost component will be the purchase price. Entity will go and buy the furniture. So purchase price, purchase cost it will pay. Next cost could be about the traveling cost. You can say freight cost which this entity will incur for bringing this furniture from the market to its location, or you can say to its warehouse. And why is this cost relevant? Because till the time this furniture is not brought to its location, it's lying at the vendor's place. Therefore, this time frame or this location gap is not something which will allow the entity to sell it. Why? Because in the normal course of the business, entity need to have all of its inventory at one place. Okay. So let's try to understand some of the cost components as around the inventory which are required to be considered. Purchase price. Purchase price, as we discussed, is about the purchase cost for an item which is purchased. Second, non-refundable taxes. If there is a tax which has been paid and that is non-refundable, then such a tax, such a duty will get added to the cost of inventory. Third, transportation charges. Handling charges, any trade discount or rebate if that has been made available to us. So let's suppose if we go purchase something which has a price of 1 lakh and we have been offered a discount of 10,000, then what will be the effective cost to us? 90,000. So this 90,000 will become the effective cost, and this is something which will become the cost of inventory first, and which is therefore required to be considered. We will not consider 1 lakh rupees. We will consider only 90,000. Let's talk about GST, which is something which is very, very relevant. If let's suppose input credit of GST will be available, then it's a kind of refundable duty, refundable tax. Yeah, this will not get added to the cost. But if let's suppose GST input is not available, so do we add it to the cost? The answer is yes, it will be added to the cost. So this we can say is the first type of component of the cost, which will form part of inventory. Second type is the conversion cost. Now this is again very, very relevant, and in this respect, in respect of conversion cost, we generally find there are a lot of confusions, there are a lot of doubts, and I'm sure you will also have some queries around it, and you will also have some points to share. So happy to have a discussion on those points also. Now, inventory is not something which will only purchase and sell. Yeah. Many businesses will be having a process of production of inventory, wherein they are manufacturing the inventory instead of just buying and selling. So whenever we produce something, we manufacture something, what will happen? Raw material will be purchased, so that will form part of purchase cost. So that component is there. After the raw material is purchased, some other costs will also be required to be incurred. Let's think about those costs. The location where manufacturing process will take place. Say the building. Either the building will be on rent or the building will be on. If the building will be on rent, rental charges will have to be paid. If the building is on, depreciation of building will be there. Now, any of these charges are what? These are the costs which are incurred for producing the inventory. These are the costs which are incurred for producing the inventory. And such costs will be added to the cost of the inventory. Such costs will be added to the cost of the inventory. Okay. Number two will be about any type of expense which is incurred during the production process. For example, other than rent, let's think about various other expenses. Will be about the involvement of manpower, salaries, wages of the labor, they will be engaged in the production process. Now, are these costs attributable to the production of the inventory? The answer is yes, they are attributable to the production of inventory. So that's why that will also form part of cost of inventory. Similarly, any other cost which is incurred and which is directly attributable to the production of the inventory will have to be captured, will have to be added to the cost of the inventory. These are, in other words, also called as conversion costs. Now there could be various types of overheads. Generally, the points of confusion. There are various types of overheads. For example, within a building, a lot of activities are taking place. Within a building, there is an administrative office, there is corporate office, separate spaces there for production. Now, for this building, if we are If we are computing the depreciation, will this entire amount of depreciation be taken to the cost of production or only a proportionate amount? The answer is proportionate. Why? Because entire depreciation of building cannot be appropriated to production process. Because production process is taking place only at the limited space in the building, not the entire building. So entire building is not getting used for the production process. Okay. Okay, that is not getting used for the production process. Now, at times, there are some other costs which are incurred. There are some other costs which are incurred for the production of inventory. And at times, borrowing costs can also be considered. You can just ignore this part of India. This is something which is in line with this, so you can just ignore this term. Now, borrowing cost, if we go to the accounting standard on borrowing cost, it says any cost which is incurred for qualifying asset will get added to the cost of the asset. Correct? Yeah. Now the question is that will the inventory become a qualifying asset? The answer is no. Generally, you will not find inventory to be a qualifying asset. Generally, inventory will not become a qualifying asset. Generally. However, in very limited cases, inventory may become a qualifying asset wherein borrowing cost will also get added to the cost of the inventory. Okay. Now, some of the components of the cost which should not be added to the cost of the inventory. Let's try to understand those components. If the material cost has been incurred, labor cost has been incurred, production cost has been incurred, but those are not in the normal course of business. Those are abnormal in nature. So in such a scenario, can we consider that to be a part of cost of inventory? The answer is no. That cannot be considered to be a part of cost of inventory. Why? Because that is not in the normal course of business. That is abnormal. Storage costs. Let's suppose if we go back to our example of trading of furniture. Furniture has been purchased, furniture has been brought to the location, and it's been kept in warehouse. And the furniture is lying in warehouse for next 3 months. Okay. For the last 3 months, furniture has not been sold. Yeah. Now the cost of warehouse, whether it's in the form of depreciation or in the form of rent, can that cost be added to the cost of this type of inventory? The answer is no. Why? Because this inventory is ready for sale. This inventory is not something which is in the process of getting ready. This is already produced. This is ready for sale. So any cost if we incur after the inventory is ready for sale will not get added to the cost of the inventory. Similarly, if we look at administrative overheads, if those are not directly attributable to the cost of the inventory, those should also not be added to the cost of inventory. Selling costs. Now, if you look at selling costs, what is the objective of a selling cost? Selling cost is incurred for sales. Have they got anything to do with the production process? No. That's why, can the selling cost be added to the cost of the inventory? The answer is no. Only those costs need to be added to the cost of the inventory which are incurred during the production process, or you can say which are attributable to the production of the inventory, or we can say till the time inventory becomes ready to be sold. Otherwise, they will not be added. Or after this stage is achieved, any other cost will not be added to the cost of the inventory. So where will all these costs go? All of these costs will therefore be charged to the statement of P&L. They will not be added to the cost of the inventory. Clear on this part? Great. So now moving further. Now for the purposes of valuation of inventory, standard specifies some measurement criteria. So first is of course about the initial measurement, wherein we say that initial measurement has to be cost, and for the cost there are various cost components. Now standard also talks about the cost formulas. As we all understand, and as we have also briefly touched upon, some of the very commonly used cost formulas happen to be FIFO or weighted average method. What do we mean by FIFO? FIFO means first in, first out. Means the inventory which comes in first will be considered as if that goes out first. For example, if an entity has purchased 10 items of furniture on day 1, say at X price, 20 items of the same furniture on day 2, say at price of X plus 1. Now, if the furniture will be sold, we have got 30 items now, 10 plus 20, 30 items are there. All the furniture is of same nature, everything is same. Now, when it comes to the valuation, if the entity is following FIFO method, then the entity will consider that the first items which the entity purchased on day 1 have been sold first. Why? Because all these 30 items are all mixed up. There's no specific identification. They're all mixed up. And while computing their value as to what has been sold out or the cost of the items which have been sold out, what will become the basis? What will become the basis? The basis will be first items sold out first. Those will be considered as if they have been sold out first. Okay. Another method could be the weighted average method. If let's suppose weighted average method has been followed. In such a case, what do we do? In such a case, if let's suppose on day 1, 10 items have been purchased at X price, and on day 2, 20 items have been purchased at X plus 1 price, then all these 30 items will be added together and their total amounts which have been paid will also be added together, and the average price for one item will be computed. Average price for one item will be computed. And whenever any item will be sold out, then we will not check as to which item was purchased first, which item was purchased second, which item was purchased third. No. Now we'll forget that. Now this will become one pool. We will say that any of the items has been sold from this pool, means any of the item has been sold out from this pool, and this sold item carries a cost which is equivalent to the average cost which we have computed. Okay, something which we follow in case of weighted average method as compared to FIFO method. Clear? Something which we follow in case of weighted average method as compared to FIFO method. In some limited cases, we also see that entities follow specific identification method. Practically, this is not found, this is rare, because it's very difficult to specifically identify individual items of inventory and to mark their costs and to then keep marking their costs on a specific item basis is very difficult. But what do you mean by specific identification? Specific identification means the item which has been purchased has got a specific identity. And whenever the item will be sold out, so we'll have a specific item against which a specific price has been marked. And when I talk about price, I'm talking about the cost price. I'm not talking about the sale price. So in a way, we will always have an identification of each and every item which is getting sold in terms of the cost price which was available for that particular. Yeah. Okay. Now, as regards the standard, standard doesn't specify as to which entity will use which type of cost formula for which type of inventory. Okay. So standard is not giving you any thumb rule. Standard is not giving any criteria for usage of these types of methods of valuation of inventory. No. This is something which is judgmental, which is based on practices and which is based on the type of inventories which the entities are having. So we cannot say that an entity which is using FIFO method is doing wrong accounting as compared to another entity which is following weighted average method. No, both the entities, even if they are dealing into same nature of business, same items, same pattern, everything all remains same. Even if they are following two different methods of valuation, for both of them, their accounting policy will be considered to be appropriate, provided we see all of other aspects remaining same. Now, in such a case, when we look at any such scenario, what type of scenario? Means wherein an entity is dealing into a particular item and another entity is also into similar sort of item. If you look at their financial statements, now how do you compare their financial statements? Therein, the first standard that we discussed will be helpful. Now, whenever we have to compare the financial statements of these two entities, which are into same nature of business, but which are following different accounting policies, this will become evident from the accounting policy of the entity. So when we will read their accounting policy, we will understand that entity A is following FIFO, entity B is following weighted average. And that's why the amounts at which their inventories are appearing may not really align. Okay, clear on this? Clear on this part? Now, as discussed that when it comes to the accounting policy, when it comes to the methods for the valuation, etc., it's very important to have consistency. Yeah, so when we talk about all of these accounting principles, all of these accounting requirements in respect of AS2 or in respect of some of these concepts under AS2, same aspect of AS1 will become applicable. That is about consistency in terms of following the accounting policy. Now, moving further, at the time of initial recognition, we discussed that inventory will always be measured at cost at the time of initial recognition. However, when it comes to the subsequent recognition means, say for example, this entity which is dealing into trading of furniture, they purchase their furniture during the year, and every time they purchase their furniture, the furniture was measured at cost using FIFO method, weighted average method, whatever it is. The method was cost. Okay, so furniture has got recorded at cost. Yeah. Now, for this entity, for this entity, when it comes to the year end or when it comes to the reporting period, measurement will have to be done again in respect of items of inventories. And this measurement which will have to be done again is called as subsequent measurement. Why? Because initially you have already recorded the inventory at cost. Now when it comes to the year end, for example, if we talk about financial year 21-22, as at 31st March 2022, items of inventories will have to be remeasured. This is what the standard requires. Items of inventories will have to be remeasured. This is what the standard requires. And when these items of inventories will be remeasured, they will not be remeasured at cost. Now a different mechanism has to be followed. Let's understand. Standard says that whenever inventory will be subsequently measured, subsequently means measurement subsequent to initial recognition, they will be measured at lower of cost or NRV. Means we already have their cost. Now we will have to compute their net realizable value. And we'll have to we'll have to compare these two amounts. Whatever is the lower, inventory will get recorded at that. Now, what is the NRV? I'll come to that NRV point also. Let's try to understand as to how this mechanism will work. Say, for example, inventory is appearing in the books at rupees 100. Now, as at year end, what do? We'll check its NRV. Say its NRV comes out to rupees 120. Okay. Now, the NRV is higher than cost. So what is lower of these two? Cost. So in such a case, what will happen? Inventory will continue to be measured at rupees 100. Inventory will continue to be measured at rupees 100. It will not change. Okay. Let's take another example. Say inventory was measured at cost at rupees 100. Inventory was measured at cost at rupees 100. At rupees 100. And subsequently at year end, what do we find? Its NRV is rupees 90. Its NRV is found to be rupees 95. Now in this case, what has happened? In this case, what has happened? NRV is lower than cost. NRV is lower than cost. So that's why now what do we need to do? We will now have to remeasure inventory to 95. Now the inventory cannot continue at 100. It will have to go down at rupees 95. Okay. This is called as measurement principle subsequent to initial recognition, wherein inventory will be measured at lower of cost or NRV. Okay. Clear on this? Now comes the question about the meaning of inventory. Sorry, about the meaning of NRV. Now we need to understand as to what do we mean by NRV. NRV, we can say, is the estimated selling price less estimated cost of completion and estimated cost to execute the sale. What does it mean? Let's take an example again. Furniture, as we discussed, is appearing in the books at rupees 100. Say at year end, what do we find? That the market value of furniture is not more than 90. It is 90 only. Means furniture can be sold in the market at only 90 rupees. And for executing the sale, 2 rupees will have to be spent. maybe on legal costs, or maybe on transportation, etc., whatever be the cost. So effectively, what do you find? That the net realizable value by making the sale will be 88 rupees. That will be only rupees 88. Therefore, in such a case, what do? We will have to cut down the value of furniture, cut down the value of this inventory from rupees 100 to 88. And the difference between 100 and 88 will go to P&L. This will go to P&L straight away. This will not be deferred. This will straight away go to P&L. This is called as method, or you can say mechanism of subsequent measurement of inventory, wherein inventory has to be measured at cost or NRV, whichever is lower. Okay, clear on this part? All right. So now moving further on to the disclosure requirements. Disclosure requirement, first of all, we can say will be about the accounting policy which has been adopted in measuring the inventory, cost formula which has been used. If there are various types of inventories, say raw materials there, WIP is there, then we have finished good, all these are required to be shown separately, something which we already have been doing in the financial statements. In case the item has been recorded at NRV, then their value of NRV are also required to be disclosed. Their value of NRV is also required to be disclosed. Now let us pick a few examples to understand about this principle of NRV. And this is something which has become very, very relevant in the context of today's times, and particularly during the period of this corona, when we had this lockdowns and etc. We have seen this NRV aspect, or this NRV principle, becoming very, very relevant for the entities. See, as at the year end, when we look at the position of the entity in terms of its inventory, in terms of its realizable value, if that is significantly impacted due to the market conditions, due to some external factors, so what will happen? Its NRV, let's suppose if it goes down, is required to be considered by the management. Management has to take care of that aspect, that the NRV has gone down, and the NRV in such a case will have to be captured at the value which is evident from the external market forces. Now, let us also understand as to how do we consider this NRV measurement in respect of inventory. Now, when it comes to the measurement of inventory, and when it comes to this NRV aspect, say a company having huge volumes of inventories, dealing into different types of inventories. When it comes to the NRV measurement has to be done on an item by item basis. Say an entity which is dealing into three types of inventories. Okay. Two types are the ones wherein the NRV is higher than the cost, and one type is the one wherein the NRV is lower than the cost. So the question is, do we really compute the total amount of costs of all the inventories, total amounts of NRVs of all the inventories, and then compare these two? The answer will be no. It has to be done on inventory by inventory basis, and accordingly, wherever we see the gap, wherever we see that NRV is going lower than the cost, this change in valuation, or you can say this decline in valuation, has to be recorded in the financial statements. Okay. Next aspect, which is again very important, very relevant, is about the reversal of any decline in the valuation of inventory. Now, by recording the NRV, what is it? Sorry, by recording the inventory at NRV, what is it that the management has done? Management has sort of reduced the value of inventory, which was mandatory. It's not something which is discretionary. This was mandatory. Say, for example, as at year end 31st March 2022, NRV of the inventory was lower, because of which entity reduced the value of inventory from 1 lakh to 80,000. Okay, so 20,000 went to P&L. Inventory's value has been reduced to 80,000. Now this type of inventory is appearing in the books at 80,000. Okay, clear? Now, let's suppose this inventory of rupees 80,000 remains unsold throughout next year. This remains unsold throughout next year. If this is sold, then this is gone out. There is no point discussing it further. If let's suppose this remains unsold and it appears as at 31st March 2023, as if the NRV of this inventory has improved. Earlier from 1 lakh it went down to 80,000. Now if you look at the NRV has gone up. It has become 95,000. In such a case, what do we do? In such a case, standard says that any decline which we had done, which was below cost, can now be reversed. So now as at 31st March 2023, NRV will be trued up to 95,000. Why? Because it is below cost. But let's suppose if there is a different situation as at 31st March 2023. Let's suppose as at 31st March 2023, NRV becomes 1,10,000. NRV becomes 1,10,000. Possible? Yes or no? Yes? Great. In such a case, question arises, can we change the value of inventory to 1,10,000? The answer is no. The answer is no. Why? Because any reversal of decline is only possible to the extent of decline. Earlier, the inventory was reduced from 1 lakh to 80,000. Okay, so what was the value of decline? 20,000. The maximum amount to which inventory can be trued up is the amount of the cost at which it was recorded earlier. We cannot take it above cost. We cannot take it above cost. What was it cost? When it declined by rupees 20,000, it was 100 or 1 lakh. Now, when we have to bring it back, it can maximum go up to the cost. It cannot go to 1,10,000. Yeah, and any change which will arise when the NRV improves or when we will reverse this decline will also go to P&L. Okay, so any decline will go to P&L and any reversal of this decline will also go to P&L. So both the impacts will always be sitting in the statement of P&L of the entity. Clear on this? Yeah. So with this, let me just quickly summarize this standard again for your reference. So as regards the inventory, what do we understand? That inventory at the time of initial recognition has to be measured at cost. For cost, there are various cost components: purchase cost, any other direct cost incurred attributable to the cost of production, or you can say incurred till the time inventory is brought to its present location, condition, and it is ready to be sold. Yeah. Subsequently, inventory is required to be remeasured if its NRV is lower than cost. Okay. if its NRV is lower than cost. If its NRV is higher than the cost, then it will not be required to be remeasured. Yeah, and of course there are certain disclosures around it which have to be included in the statement of financial, in the financial statements of the entity. Clear on this? Yeah. So with this, we come to an end to our discussion on this tender. So let me just go to your queries now. Happy to have your questions, doubts, and then we can move on to the next topic. I would request if you can just share the queries of the participants.
Sir, hello.
Yes, if you can just share the queries of the participants.
Yes, sir. There are one question. I just share my screen.
Sure.
Third question. My screen is
Okay, this third one. Okay, let me just read out the query first of all. How the classification issues of imported materials involving levy of custom duty at higher rates than applicable and when paid under protest was subject to litigation be dealt with for the purpose of cost of imported materials. See, in such a case, you will have to understand the basis of measurement which you have followed. If we are saying that a particular rate is applicable, but the rate which has been charged is higher than the applicable rate, and the higher rate which has been charged is under protest. Okay. Now, in such a case, we'll have to appreciate this fact. Let me just put this in the form of numbers. Say, for example, inventory was purchased at rupees 100, on which duty should have been 10. So the cost should have become 110, but the actual duty which has been charged is 12. Now the question is, do we include these two as the cost of inventory or not? Yeah, so that's the question. Now, in this case, you will have to appreciate the fact that whether it is a part of litigation or not, irrespective of that, this has been paid. Now, let's suppose if this litigation goes in the favor of the entity, then this too will become refundable. Yeah. Otherwise, this too will become part of the entity's cost, which is appropriate to be taken to the cost of inventory. So I would suggest in such a case, it is always appropriate to make it a part of cost of the inventory. And subsequently, if that is something which goes in the favor of the entity and this is something which is refunded, that can always be adjusted against the cost of the existing inventory at that point. I can understand there's going to be a time lag, but this time lag, I do not expect that to be a very, very significant amount. Yeah, otherwise what will happen is otherwise such types of amount will continue to flow to the P&L, which is other than the cost of production, which doesn't seem to be the appropriate accounting. So that's why to avoid that sort of situation and to ensure that all of these types of costs move to the cost of production, it is always appropriate to consider them as part of cost of inventory. Okay. Yes, any more questions, any more doubts in case you have this? All right, so I think we can, before moving on to the last topic, I think we can again take a small break of 5 to 10 minutes and then we can start.
Can I go, sir? Hello.
Hello.
Yes, sir. So we have one more questions. We'll take it up on this one is related to the first one. So what about prudency to be followed? The question and the second.
Yeah, as regard the prudency, so definitely yes, the principle of prudence has to be followed always, and this is something which goes around the accounting principles or which goes around the accounting standards. Okay. Moving on to the next query. Cost of services incurred before 31st March, but not billed. Cost of services incurred before 31st March, but these were not billed up to 31st March. Example, cost of making a film, or in the cost of supply of laborers, where wages have to be paid each month, but billing for supply of laborers can be made at the end of each quarter. Okay, so you are talking about the prudence principle. See, as regards all of these principles, you have to understand the fact that because all of these costs have been incurred, yeah, therefore all of these costs have to be accrued up to the 31st March for sure. Number two is around their billing. So now for the billing, we are talking about the revenue recognition, for which the relevant standard is AS9. AS9 says that we have to follow accrual concept for the revenue recognition. So if there is any billing which is in respect of cost which has been incurred up to 31st March, in that case, if the invoice has not been raised, that doesn't matter. The revenue has to be recognized. And please remember that raising of an invoice and revenue recognition are two different things. For example, say we supplied laborer to a customer, and our arrangement was that for the laborer that we supply, we will charge you at the end of the month. Now, as at 31st March, the cost for the labor has been incurred by us, but the invoice has not been raised. When will the invoice be raised? 10th of next month. Okay, maybe for our convenience purpose, we'll raise the invoice on 10th of next month. In such a case, the question is, should we not book the revenue for this cost or for the services that we have rendered to the client? The answer is no. We have to recognize revenue. So that's why please remember, the revenue recognition and invoice are two different things. They may or may not align. That doesn't matter. Our accounting has to go as per the accrual concept. I hope this clarifies.
I'll give back the rights so you can start sharing.
Well, yeah. So moving on to the last topic for the day, that is about accounting standard 7. And as regards accounting standard 7, let us understand as to the relevance of the standard and the context of the standard. We have touched upon certain points related to revenue recognition today. And we have also discussed that for the revenue recognition, the standard which is relevant is AS9. Okay, means AS9 tells us the principle to be followed for revenue recognition. However, whenever it comes to the construction contracts, then the revenue recognition will not be as per AS9. Means AS9 deals with the revenue recognition for all the contracts except the construction contracts. For the construction contracts, revenue recognition has to be as per AS7. So we can say, in a way, there are two standards which deal with revenue recognition. One is AS9, which deals with all except construction contracts, and the second one is AS7. Yeah, so understood the context, understood as to what is really relevant in terms of the standard. So now it's important first of all to understand about the meaning of a construction. It's important to understand as to what will get covered under construction contract and which is therefore not covered under AS9. Okay. Now let's understand the meaning of a construction contract. A construction contract is a contract specifically negotiated for the construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of their design, technology, function, or their ultimate purpose or use. And I think this definition will be best understood with the help of some examples. When it comes to construction of a road, construction of a dam, construction of a bridge, what are these types of contracts? They are nothing but the construction contracts. Why? Because when you talk about construction of a road, therein we are talking about a single contract, which is for this entire road, whether it goes on for 5 kilometers, 7 kilometers, or 1 kilometer. Yeah. We can also say that these construction contracts are generally for a period which is 12 months or more. Generally, construction of a building, construction of a pipeline, construction of a ship, construction of a tunnel, they are all examples of construction contract. And generally, you will find that the construction contracts will take a period of 12 months or more to get complete. Generally, it's not a rule, but generally you'll see this is happening. Now, construction contracts could be of two types in terms of the cost which will be incurred and in terms of the price which will be charged. One is a fixed price contract. For example, there is a contractor who has been awarded the work for construction of a road for 2 kilometers. Okay. So he will construct the road for 2 kilometers and a fixed amount will be paid to him. So fixed price that the contractor will charge is what? Say 20 crore. He will charge 20 crore for construction of this road. Now this is a contract of a contractor wherein he is charging a fixed price. There's no variability which is involved. Fixed price is there. There could be another model on which the contractor may work. Let's try to understand this other model. In this other model, contractor will add a markup on the cost which he'll incur. This markup or this profit margin of the contractor will be fixed. This will be agreed beforehand. Before starting the contract, this margin will be fixed. This margin will be agreed. But the amount is not fixed. For example, whatever cost contractor will incur, he will charge a markup of rupees 10% on that cost. Okay. Now in this case, is there any fixed price which is involved in the contract? The answer is no. And let's also try to understand as to how is this different from a fixed price. Generally, in these types of contracts, cost for the project is estimated at the time of beginning of the contract. Say for example, contractor has estimated that he will incur a cost of 100 crore. So therefore, the price that he will charge will be approximately 110 crore. Why I'm saying approximately? Because if the cost remains 100 crore, then he will charge 110 crore. But the only thing is that the cost which he has assessed or which he has agreed is the estimated cost. This is not the fixed cost. This may go down, this may go up. This may go down, this may go up. So these types of contracts which are based on estimated cost plus a fixed markup are called as cost plus contract. So we may be having these two types of contracts whenever it comes to the construction contracts. Okay. Now, let's try to understand some of the components of the contract revenue. One will be, of course, this fixed price or this cost plus. Second could be because of certain variations in the contract. Say initially, the project which was awarded carried certain items to be constructed. During the period, some of the components have been increased. Some of the work has been changed. So there are variations in the contract, because of which what will happen? Additional price will come. Sometimes a price is also charged for the inflation. Say for example, initially two parties agreed that the contractor will complete the work in 2.5 years. Okay, but the work has still been going on. It's been 4 years. Now, because there's a long period, so that's why because of inflation, costs have increased significantly, which is having an impact on the profitability of the contractor. So that's why in some cases, contractor will negotiate with the customer for increasing the revenue. These are again some part of variations, or you can say claims, which the contractor may ask from the customer. But all of these are dependent on the terms and conditions of the contract, whether all of these clauses were available in the contract or not, basis which he can demand for all of these components at later point of time. Clear? Costs. Costs, as we have discussed, are in relation to the project, and in relation to the project, in this case, I'll use some of the principles of inventory, AS2, that we have just covered. And I'll just try to correlate some of those principles of AS2 with AS7. Now, because it's a long-term contract, which will take more than 1 year to get completed. So what will happen? As at the year end, certain costs would have been incurred. Say out of 100 crore, during the year, 60 crore has been incurred. Okay, 60 crore has been incurred, and no revenue has been recognized. Why? Because let's suppose the revenue recognition criteria has not been met. In such a scenario, what do we do with all of these costs which have been incurred? Can we charge it to P&L? The answer is no. We cannot charge it. We cannot charge it to P&L. So where will it go? Where will it go? It will go to project WIP. So there is a separate head which is required to be considered in this case. That is called as project work in progress, which is a kind of inventory. So it's an inventory which is being built up till the time it is sold off, or till the time the revenue is recognized against this. So it will keep getting accumulated as WIP, that is called as project. And as regards this project WIP, will have certain costs. So what are the cost components? We'll now look at the same cost components which we discussed in case of AS2. Site labor cost, material cost incurred for the project, which are directly attributable to the project. But any sort of abnormal cost, any cost of selling cost, can those form part of the cost of the project? The answer is no. Clear on this? Okay. Now, moving on to the revenue recognition criteria. The revenue recognition criteria. AS7 says that revenue has to be recognized on the basis of percentage of completion. And please again understand the fact, as we discussed, that revenue recognition and raising of invoice may not align. So it's not necessary that the invoice is raised at that point of time, revenue should also be recognized. No. It's not necessary to recognize the revenue when the invoice is raised. Okay. So now in this case, what do we do? Standard says that during the year, we will check the percentage of work completion. And on the basis of percentage of work completion, we will recognize revenue. On the basis of percentage of work completion, we will recognize the revenue. Let's understand how. So the contract revenue was 150 crore. Okay. Estimated cost was 100 crore and the fixed price contract is therefore 150 crore. 150 crore. Now during the year, let's suppose 33% work has been completed. How do we determine this percentage completion? I'll come to that point also. But let's suppose 33% work has been completed. Now, because 33% work has been completed, so during the year, what do we do? This total contract revenue into 33% will be recognized as contract revenue during the year. So we'll book the revenue to the extent of 33%. So that means 150 crore into 33%, 50 crore will be recognized as revenue during the year. 50 crore will be recognized as revenue during the year. Okay. Now, for the purposes of percentage of completion, certain bases are available. Let's try to understand what could be the basis for determination of percentage of completion. First is technical evaluation. Technically, an engineer may certify as to what's the percentage of work completed. Okay. Second method is to determine percentage of completion on the basis of labor hours spent. Is to determine percentage completion on the basis of labor hours spent. Say during the year, 1,50,000 labor hours have been spent. And it is estimated that for completing the contract, 4,50,000 labor hours will be spent. So 1,50,000 out of 4,50,000 labor hours have been spent. Therefore, what is the percentage of labor hours which have been spent? 33%, 1/3. So that's why we can also follow this basis of labor hours spent divided by estimated total labor hours, which gives us 33%. Third and the most commonly used method is the cost method. Okay, wherein we check as to what is the total actual cost which has been incurred during the year. let's suppose this project has a total estimated cost of 100 crore. And during the year, 50 crore has been spent. During the year, 50 crore has been spent. In this case, what do we say? That on the basis of the cost incurred, 50% work has been completed. 50% work has been completed. So that's why, what do? We will recognize 50% revenue in the first year. Standard doesn't specify as to which method is used or which method is required to be applied for determining percentage of completion. Standard doesn't specify. Standard doesn't give any recommendation. But practically, what we see is that this actual cost divided by estimated cost is the most commonly used method for determining percentage of completion for revenue recognition. This is the most commonly used method. Okay. Another aspect which the standard requires us to follow, and which is on the lines, on the principles of prudence. We understand that the revenue is recognized on an accrual basis based on percentage completion. And on the basis of revenue recognition, what will happen? Profits will get recorded over the period of the contract. Whether the contract is running over 4 years, 5 years, 2 years, 3 years, 2.5 years, whatever is the contract. So that means the revenue will get recognized over the period of the contract, and accordingly profits will also get recognized over the period of the contract if there are any profits in the contract. Okay. But let's suppose if the project is into loss, if the contract on an overall basis is into loss, in such a case, standard says that if you see that the contract on an overall basis will result into a loss, then you should recognize the loss upfront. You should not wait for this loss to get recognized over the period of the contract. You should recognize it upfront. Let's take an example. See, during the year, we started a contract wherein the projected estimate, wherein the estimated cost was 100 crore. Okay. And the contract revenue was 105 crore. So this project was taken up in April. After 3 months, after 6 months, management estimated that their initial estimate of 100 crore for the entire contract was incorrect. When the project will be completed, when the contract will be completed, that means 3 years from now, the total estimated cost will be 110 crore instead of 100. So there's a change in estimate. And this change in estimate is possible because estimates are not actuals. They are not 100% accurate. They are based on approximation. They are subject to changes. Now, during the year, we are into a situation wherein the revenue will be recognized over a period of 3 years. Let's suppose contract will get completed over 3 years. So revenue will be recognized over 3 years. But during the first year itself, what do we find? By comparing the total estimated cost with the total contract revenue, we find that there will be a loss of 5 crore. On an overall basis, there will be a loss of 5 crore. Correct? Yeah. To this, the standard says that now we have reached a stage wherein we know that the contract will eventually result into a loss of 5 crore, correct? So now, if we continue to follow percentage of completion method, and if we continue to book the cost and the revenue on the basis of percentage of completion method, then what will happen? This 5 crore loss will get recognized over a period of 3 years. This should not be done. Standard says this 5 crore loss should be recognized in the first year itself. This 5 crore loss should be recognized in the first year itself. We should not wait for this loss to get deferred. Yeah, this is on conservative principle. This is following the principle of prudence. Clear on this? Yeah, this is something which is very, very important for us to consider, and this can really have an impact on certain aspects of it. So let's take an example now. B Limited undertook a construction contract for 50 crore in April 2014. Cost of construction was initially estimated at 35 crore. Contract was to be completed in 3 years. While executing the contract, company estimated cost of completion of contract at 53 crore. Can the company provide for expected loss? There's an expected loss of 3 crore now during the first year. The answer is yes. When it is probable that total contract cost will exceed total contract revenue, expected loss should be recognized as an expense immediately. Therefore, in the given example, foreseeable loss of 3 crore, 53 crore less 50 crore should be recognized as expense immediately in the first year. That means during the year 14-15. Clear? Clear on this? Okay. Then I think we can just touch upon some of the aspects related to guidance note on real estate transactions. Now, under Indian GAAP, we also have a guidance note which deals with the accounting of real estate companies, which is something other than what we talk of about AS7, but I thought it's really relevant in the context of the topic that we have been discussing. Now, as regards the real estate transactions, most of the principles regarding their accounting, regarding their revenue recognition are in line with what AS7 also suggests. However, there is also a guidance note which is required to be considered. This guidance note requires certain considerations to be given, which requires that expenditure has to be at least 25%. Saleable project area has to be at least 25%. At least 10% of the total revenue as per the agreement of sale are realized as at the reporting date before we start recognizing revenue. If any of these have not been sort of complied with, okay, if let's suppose we say that collections are only approximately 1%, but the percentage completion is say 50%, so can we recognize revenue? The answer is no. Okay, so these are some of the aspects which I suggest you to look into, specifically related to the real estate transactions, which are covered by the guidance note separately, other than what AS7 requires. However, largely the accounting which the real estate companies have to follow is also in line with what we have discussed in case of AS7. Moving on to the disclosure requirements, I think some of the most important disclosures are about the revenue recognition, the percentage which has been computed, the basis of the percentage computation, and of course, as around any of the costs which have been incurred, if there are any foreseeable losses which have been recognized, or if they exist during the year. Yeah, so these are some of the important disclosures which one has to consider while looking at the requirements of accounting standard in the context of preparation and finalization, preparation and presentation of financial statements. All right, yeah. So with this, we come to an end to our discussion on AS7 also, and I think we are really done now in terms of our discussion for today. And happy to have a discussion around your queries, questions, if any, before you really move. But some of you may not really want to continue discussing the queries. So before you really move, thanks to everyone for sharing your time. For participating in today's session. Thanks so much for your time for the day. And now I can move on to your queries. So I would request if you can just share the queries of the participants, if any, as around this topic also, or as around any of the things that we have discussed during the session.
So we'll take up the questions, right, sir?
Sure.
There's 1 minute.
Sure.
Compiling it. Let's display it on screen.
All right. So I'll read out this query first. In a service contract where expenses have been incurred and bill has not been raised before 31st March, and if the revenue income is to be recognized on accrual basis where the bill has not been raised, practical situations are relevant. If the progress of service is not fully completed and the revenue can't be estimated pro rata, if the income is recognized on accrual basis, there will be no TDS by the customer before 31st March without a bill, then we need to pay income tax thereon from our own pocket. Instead, why not carry forward the expenses incurred as WIP like closing stock? So let me just clarify. One of the point is around the income tax which you have shared. There could be another point around the GST which you may not have specified. So let me just tell you that some of these constraints which you have specified have nothing to do with the accounting requirements. When you say that if you will record the revenue on accrual basis, but the customer will not record that on accrual basis, and because of which customer will not consider deducting the TDS and therefore you will not be getting the credit of TDS. So this is something which has to align with the requirements of customer also. So I agree with you. But can we do our accounting incorrectly just because my customer is not recording that correctly? The answer is no, that is not possible. Secondly, when it comes to the accounting requirement to the vendor as well as the customer are same. Those are not different. So if for some reason you are recording the revenue on accrual basis, it is also mandatory for the customer to record it on accrual basis. If he is not following that, he is doing wrong accounting. Okay. And this accounting is also something basis which compliances are required to be taken care of. If for any reason customer is not accruing this expense within the year when you are recording this as revenue, then this is not only incorrect from accounting point of view, this is also incorrect from income tax point of view. Okay, yeah. All right, moving on to the next query. While recognizing revenue under percentage of completion basis, should the estimated cost of marketing expenses be deducted? See, when you will pick up the costs, you will pick up only those costs that we have discussed. When it comes to the marketing cost, that doesn't form part of project cost. Remember the cost components, so that is not required to be considered by. Second, are we under obligation to consider the principles enunciated by guidance note, which are not? See, when it comes to the guidance note is only in respect of real estate transactions in terms of recording their revenue and there's nothing which this standard, which this guidance note requires, which is not in alignment with the requirements of AS7. Okay, so this is something which is in addition to what AS7 requires. So there's no conflict as such. Next, as an auditor, how can we verify whether the estimate of management that the cost of contract will exceed the contract revenue and the resultant loss booked is correct? So your query is around the audit of the estimated cost, which is definitely a challenging thing, and there's no doubt this is something which is very subjective, because there's not something which is based on actuals, but uh, this has to be done by taking the appropriate details from the management, by understanding in detail as to what all components of the cost they are going to incur. For some of the cost contracts, they will have some backup contracts. For some of the cost contracts which are going to be incurred, they will also have backup contracts. And some of the projected costs for which the contracts are not available, the management will have some basis. Yeah, so management will have some assumptions. So it's very important for us as an auditor to get into that perspective of the management, to understand that complete cost structure of the estimated cost. If we are able to audit that estimated cost, then definitely we will be able to look at as to whether this foreseeable loss is correct or incorrect, or if there is any foreseeable loss which has not been recognized by the management. Now, having said that, audit of estimates is very important. And for audit of estimates, there is a separate auditing standard which is available. Okay, this is not something which can be ignored by authority. This is extremely important. Yeah. Okay, moving on to the next query. Cost of warranty clauses treatment and taxation disputes, if any, at the close of the contract. How to recognize for closure of contract accounting? See, as regards the warranty clauses, the provision for warranty has to be recognized in the books of accounts. And as regards the taxation disputes, for taxation disputes, again, we have a separate standard, AS29, which deals with this, which suggests as to whether it should be recognized in the books as a provision, or this should be disclosed as a contingent liability. So I would suggest these two are driven more by AS29 rather than AS7. But yes, both of them are required to be appropriately taken care of as per the requirements of AS29. Okay, clear on this?
Other questions, sir. So are we done with the session, sir? Is there anything to be shared with the participants?
Yeah, we are done. We are done. So
Thank you so much for your time, sir. Also, over to you, sir. For
all right. Thanks everyone for your time.
sir, over to you, sir.
Sorry.
Yeah, just
Okay, thank you, Achal Jain sir. The speaker has given an excellent presentation for 3 hours on 3 accounting standards. And the meanwhile, he has touched upon all the guidance notes relevant to the accounting standards also. I have once again thank you the speaker and the members for your patient hearing. Thank you, sir. Thank you very much.
Thank you so much, sir. Thanks so much.